hope you're ready for more short-termism, at least more discussion of short-termism. We start with our second keynote speaker, first Professor Zacharias Sautner from Frankfurt School of Finance. He already gave a version of this talk about for ECGI on an earlier roundtable and also other earlier conferences. But I think there's also some more recent research, especially in relationship to climate change. I think it's going to be super interesting. Thank you.
Thank you very much for the invitation. As I was sitting in the audience, I started to think how I will have to revise my presentation, given all the things that have been said. So what I'll do is I'll be a little bit faster on the generic finance evidence on short-termism, and I'll try to emphasize a few things a little bit differently than in the previous presentations, and then I'll move to more specific evidence on climate, because I've been working for a while on climate finance, and Tom wanted me to also cover that. And as you'll see, the challenge was a little bit to combine all of that in one coherent presentation, and especially how to think about short-termism in the climate finance context, not about climate change and short-termism in climate change, but more in the specific finance domain, bringing in what Tom wanted to do, which is some of my own work. So most of this talk is informed by my own research and the research findings by others, and especially as we move further ahead in the presentation, I'll also provide some more speculation. That is to say that I'll speak about some issues where I think there's a narrative that there is a problem of short-termism in this or this domain, but we don't have the papers yet, right? So I'll try to caution a little bit that we need more work on these areas. So it's heavily biased by my own work on short-termism, and in particular on compensation and on climate finance. So I think we have seen already several presentations that we're having a similar slide, which is defining what short-termism is. It's actions at the expense of long-term firm value. And I'm also having here on the slide something that I consider is very important, namely that there has to be some notion of markets not getting it, market mispricing. Because if you think about the traditional example, which is the manager cutting R&D in order to report higher earnings to meet or beat earnings targets, that will only create a positive stock price response if the market doesn't understand that cutting these expenses will, if you think about a discounted cash flow model, reduce overall value because of lower cash flows in the future, right? So there needs to be some narrative of the market not getting it. What I'll also stress in this talk, both in the finance and climate finance space, is that I think of short-termism primarily as a response to incentive structures. Okay, so if we want to think about a cure for short-termism in certain parts of the system, because as I'll say later, I don't think it's a systematic problem, it's in certain parts of the system, we have to think about incentives. And the same applies, as I mentioned earlier, to the climate space. Okay, so I'll start with the more generic finance evidence. And this is a slide that is from my previous ECGI talk. And I'll not go through all the details. In that talk, I tried to look for evidence on short-termism in three key areas, which was executive compensation, financial reporting, and ownership. And as you can see here on the slide, we are also having papers on all of these topics here on the conference. And what I'll try to do was try to distill a little bit what the evidence says. And as you can see from the slide here, most of the evidence I refer to is evidence on the firm level, rather than at the macro level. I know some of you have done important work on the macro level as well. The reason why we don't have a lot of papers in the finance journals on the macro level is because of the challenge that we have in finding the counterfactual, right? And you were mentioning that earlier, Marcus. So when you said, okay, so R&D went up, but we don't know how much it would have gone up if we would have less of a problem here and there. Right, so that's the main challenge. So most of the work that I reported on was trying to incorporate what in economics is called the credibility revolution. So trying to establish causal estimates of the effect of X on Y in that space here. And so the summary basically the summary slide basically that I had at this presentation was highlighting in red areas where we have some evidence on short-termism being a potential issue, in yellow parts where there's mixed evidence, and then also in green areas where I would say there's no evidence. And what I should stress is that I would say the first two bullet points in these specific areas, I'm highlighting always specific areas, I think there we have pretty strong evidence of causal effects of short-term incentives on short-term actions at the expense of long-term value, of short-term reporting on short-term actions at the expense of long-term value. But we don't have that really on the ownership side, because there's hardly any paper that I'm aware of, maybe there's one I'm not aware of it, that really has a tool to break this challenge of what causes what. Right? So that's why I would be more careful with interpreting the evidence on the ownership side, comparing, let's say, private versus public firms. Right? There's some great work that was cited, but also there, firms don't happen to be private versus public, and you can do lots of magic, but it's not random. And also, if we think of long-term versus short-term ownership, yeah, and I have also some evidence later on that in the climate finance area, keep in mind this is not well identified in terms of this credibility revolution, that we really have a causal estimate, right? It's correlations. Because you cannot just randomly say you're a long-term investor, you're a short-term investor, and then we see how that affects firm behavior. Let me also highlight something that goes against this public narrative, which is that activists are bad. That's not what the evidence showed, right? And we've heard about some of the papers here. So overall, we have to be very careful, with putting everything into one bucket and just blaming short-termism for everything. So, this is now the new slide, trying to make a bit of a broader conclusion of how I see the evidence that has been accumulated. I would say that the financial system as a whole is not broken because of short-termism. So we don't have a systematic problem in the system, but that does not mean that there are parts of the system where short-termism is a problem. And we have to carefully think about where that is and for what kind of firms it's applying. And now it's getting a little bit technical. That's because the papers that I'll show you that provide this causal evidence, including one of my papers, what they do in order to break this endogeneity, what causes what problem, they try to identify a so-called local average treatment effect. So that's what econometricians use in order to specify how generalizable an effect is. Okay, so the effect that I'll show you, for example, on the effects of equity vesting and therefore the horizon getting shorter on investment, and that's identified for a specific set of firms. Okay, so we should not conclude from that evidence, which is probably pretty clean, yeah, that the same applies to all firms out there, right? And just to illustrate this with an example, maybe that highlights the difference is, suppose you want to see what the effect of having supporters in a football stadium is on the success of the home team, right? So your narrative could be you have more supporters, you have a better performance of the football team. Now, running regressions to test this is difficult because it's not exogenous, it's not random how many people are in the stadium, so you cannot just test. But what you could do is you could say, let's make it a function of the weather, whether on a Saturday afternoon there's good weather or not. If there's good weather, more people go to the stadium. And then you can see whether, if you instrument for that, there's an effect on the weather to more people in the stadium on the football success, and see whether more supporters in the stadium leads to better performance. But the problem is, now we become kind of technical, that the type of people that are going into the stadium because of the good weather is probably people like me, right? Because I'm not really a football supporter, but there's great weather, or we don't know what to do, we want to be outside, let's go to the stadium. So very different probably, right, reacting to that instrument, the good weather, than the average person in the stadium, okay? So therefore, we have to be very careful with what we learn from good weather, more people in the stadium, higher success of the home team in terms of the general evidence, right? So the same applies here, and I stress that because we really have to be careful with how to interpret these papers that are cleanly identified, because they often rely on this local average treatment effect. So under certain circumstances, there is evidence on short-termism, and that will get more concrete as I move on in the slides and show you, specific studies. So again, coming back to the activists, I think we have to be careful with not incorrectly blaming certain players of the financial system for causing short-termism, because they actually create value also in the long run, as the evidence shows. So we also need to be careful then with thinking about the therapy and not coming out with rules that should apply to all companies. Let's get more concrete on some of the parts where I would say there's pretty compelling causal evidence also that short-termism in these specific circumstances is an issue. That's a study in the RFS by Edmonds, Fung, and Llewellyn, and they want to explain investment behavior, R&D, and CapEx spending by companies as a function of the equity, the options, the restricted shares that vest become exercisable in a given month. If you have more options that become exercisable, you can sell them after the shares after exercising the option. You become more interested in the short-term stock price. Right? Then if you have vested equity, which you have to continue holding for a year, 2 years, 3 years, they are also caring about the stock price in 2 years and 3 years. So what they show in their paper is that if in a given quarter more equity vests, and then in that quarter, managers have a stronger incentive in the short-term stock price, potentially, bigger myopia problems, these firms also reduce investment. Okay, so again, under the specific circumstance that there is equity vesting and you react to this, there's an effect of the incentive horizon on long-term investment. The study that I have with Tomislav looks at something similar, but takes a slightly different approach to show the same effect, which is we look at options that are accelerated. So that means that you have an option where you typically have a vesting period. So for the first 2-3 years, you're not allowed to exercise. So you have to keep on holding the shares or the options. You cannot cash in. And because of a change in accounting regulation in the US, a set of firms accelerated the option vesting periods to avoid accounting costs. So they reduced the vesting periods that used to be 2 more years, 3 more years to 0, allowing the executives to immediately exercise the options and cash in the value from selling the shares. So for them, the horizon got shorter. Now, of course, also here, there's the question of, is this random or not? So in the paper, we have an instrument, which is a way to break this problem that it's not random whether you accelerate the vesting periods or not. I don't want to go into details. But after incorporating this instrument and trying to do the econometrics properly, we also do find that in firms where a lot of equity is accelerated, a lot of equity quasi-randomly vests, and the horizon of the managers get shorter, we see cuts in R&D and in CapEx. So also here, I would conclude that overall, short-termism as a system-wide issue, maybe not a first-order problem, but in specific areas, especially compensation, we need to still think carefully about proper design of providing long-term horizons, and need to be careful when a lot of equity vests, or if option vesting periods are accelerated, right? Because then under these circumstances, there are incentives in place that may cause managers to cut long-term investment. So that's not to say that in general, in equity-based compensation, there's a short-termism problem, but it does say that under certain circumstances, we need to watch out. So this is now the second, an example from a study from the second bullet point, quarterly reporting. So this is more of a history of finance paper, I would say, than an accounting journal, because it looked at the causal effect of moving from annual to semi-annual and later to quarterly reporting in the US and how that impacted investment. Also here, you see that there is a negative coefficient if you look at the treatment effect. So before versus after quarterly reporting. What you see is that also here, firms did respond to the shortening of the reporting period by cutting investment. And in a sense, this is also consistent, and and I'm speculating a little bit more with something you hear a lot from practitioners. I've been working on capital budgeting earlier in my career, and if you ask them, how do you budget investments, how do you budget your plans, they would tell you that they would look at the expectations of the market for the next quarterly results. And what do they expect in terms of earnings per share, and then backward engineer how their internal plans have to look like so that they meet at least or beat the expectations of the market. So that's at least how lots of CFOs think, rather than bottom up, where the best investment and what can we do, rather than that they go top down from basing the capital budgeting on the expectations of the market. So here, in terms of investor horizons, as I said earlier, we have to be much more careful because there's not a lot of strong causal evidence. It's more kind of correlations. They do suggest that at least there's a correlation between the presence of short-term investors and less investment, more broad empire building, or worse M&A decisions. But again, here we have to be more careful with interpreting this. So let me move then to the more specific climate finance evidence. So maybe this is the picture showing the epicenter of human short-termism. It's showing over the last 800,000 years carbon dioxide levels in the atmosphere. And you probably know how this is constructed. That's when you see these pictures of research teams in the Arctic digging in the ice and getting these ice cubes from dozens of meters down the earth up, and then seeing how the ice is composed, so they can infer from that how the parts per million CO2 in the atmosphere looked like over the human over the last 800,000 years. And what you do see is there's a lot of up and down, but clearly what it's been happening in the last 50 years is by all means extraordinary. So probably showing that we all care about our future, but not about the long term of the planet. But that's more general. So, before getting to the more specific evidence, and the problem of all of that is that in order to meet the climate targets, we have a huge problem. So what this figure is showing, that in order to, for example, meet the CO2 targets of the Paris Agreement, as we all know, we have to reduce emissions. And what you see here is over the period from 1980 to about 2018, the amount of emissions we've been blowing up into the atmosphere, is that in order to meet the Paris Agreement target, we have to massively reduce the emissions. And according to these estimates, if we want to continue emitting carbon for another 9 years, then the total budget that we have is basically depleted. Now, that study is from 5 years back, so we've already continued to deplete the carbon budget we have. So we have kind of 4 more years left. And what you see here is if we continue for 4 more years or 5 more years, as we do at the moment, we have to change the steering wheel very massively, right? So you see the different mitigation paths that we have to follow in order to meet these targets. And you see that that's going to create a lot of short-termism for the companies, because they have to very, very strongly change on the short side their behavior. It's a different sort of short-termism, right? But it's likely going to create a lot of problems for lots of companies, because that means that a lot of regulation has to really be beefed up very massively in order to get these mitigation paths. Okay, let me start with a quiz. I have 2 quizzes in the slides. So who said this? It's fitting to gather views on the long term for a business audience, given the pervasive short-term pressures CEOs are under to demonstrate performance. And then he or she goes on saying, climate change is where short-term thinking and long-term consequences collide for businesses and governance alike. Meeting the challenge of climate change calls on both to assess the risk and act before the economic and environmental consequences of failure. Right? So blaming that short-termism is not just in the space of businesses, but also governments. So who said that? Hank Paulson, all right? So former US State Treasury Secretary under the Bush administration and former chairman and CEO of Goldman Sachs. Now, he wrote this for a McKinsey publication. What I think is interesting in his arguments is that he's comparing what we're doing with climate to what happened when he was responsible with others in addressing the financial crisis. So he says, today we are making the same mistakes when it comes to climate change than we made in the lead up to the financial crisis. And that's 2 points. First, he says we're building up excesses again, but different from back then, we were building up debt excesses. We're now building up CO2 excesses in the atmosphere. Second, government policies are flawed back then and now. Back then, we were providing incentives for borrowing too much to finance homes. Now we're providing incentives for the use of fossil fuels. So also here, clearly, short-termism is a response to incentives. It's the externality problem that isn't fixed. That's creating the problem we have. So the first best will always be to solve the externality problem rather than to use investors, shareholders, and others to put pressure on companies to get clean. But unfortunately, we don't see this first best, and I'm not expecting this to happen over the next years to come. So the climate crisis won't suddenly manifest itself with a burst like that of a financial bubble. He says climate change is more subtle and cruel. Okay, so key point also here, it's all about the incentives. We have to fix the incentive structures. Now here it's more difficult, as I just said, than in the corporate context where we can set up proper vesting periods, maybe change reporting structure and so on, because here we need agreement across all countries in the world. And I don't think this is going to happen. And I also don't think we're going to meet the 1.5 degree target. And I think all companies that are not preparing properly for adaptation will be in trouble moving forward. Okay, but let's think a little bit more about the evidence we have. So the evidence on short-termism, more vaguely defined now here, in the climate finance space, thinking about the role of finance and investors. And I'll try to separate this in two topics, thinking about short-termism and how we tackle climate change and how we exploit climate change concerns, greenwashing and these things. So on tackling climate change, thinking about investors being eventually ultimate owners of companies and therefore responsible for what the companies are doing. We have this paper where we asked investors, institutional investors, and we have lots of top executives at these investors on what climate or temperature expectations they have. And what you see here is that all relative to the Paris Agreement targets of not increasing temperatures by the end of the century by more than 2 degrees, ideally 1.5 degrees, is that 4 in 10 investors that we ask expect 3 degrees or more. Scenarios that, according to the CEO of AXA, are not insurable anymore. So really disastrous expectations. So in light of what they expect, as owners of companies, you should expect them also to really do something against it, to hedge themselves and to engage with companies. But what we find is that that's not what they're doing. Right? They should really care about the long-term consequences of climate change, but they hardly do anything. So the bottom line of our paper is that the vast majority, maybe they're analyzing the carbon footprint of the portfolio, yeah, but also only 1 out of 3 investors are doing that. And it's all far away from thinking about hedging strategies or also engaging properly the companies to make them reduce emissions. Right. So here we have a bit on shareholder engagement over climate issues, and also here the bottom line is that even the very basic things such as voting against management on proposals over climate risk issues are only conducted by 30% of the investors. So there's a big gap between how dire the expectations are and what consequences that will have for their portfolio holdings and what they actually do. Right. So in a sense, that's a form of short-termism that, especially if you're a long-term investor, that you should really worry about, the consequences of not doing engagement. So there's a bit of evidence on the link between investor horizon and some climate-related outcome variables. Caroline Flammer has this paper where she shows that in companies where you have more long-term investors that are engaging in shareholder proposals, so more long-term investors with all the problems that the measures have, you see more reporting on climate change issues. Why is reporting on climate change issues an important variable? Well, because, and lots of focus is on it now, because there is this idea that if you disclose more on climate risks, you have more public pressure to also reduce emissions, which is what we eventually care about. So therefore, this is an important intermediate step. And so this evidence shows if you have more long-term investors, all the problems that come with the measure, you have more disclosures in the companies. That's consistent with something that I have found in another paper, where we look at different measures of investors' incentives to care about the long run, whether you're more climate conscious because of where you're coming from, you care more about the long term because of social environmental norms, or whether you are subject to stewardship codes that make you care about long-term issues by kind of design of the codes, or whether you're more of a universal investor that has a universal portfolio, and therefore you cannot divest from assets that have physical exposure like real estate, hotel. Think of the Blackhawks of this world, but also others, the Amundis and so on. So in firms where you have more of these investors that care about climate issues, we also see more reporting, more disclosure on climate risks. Also here, that's not a causal estimate. In the paper, we have some more work trying to establish also the causal effect because of a French law actually that increased the demand for climate disclosures among French investors. But so this in itself is certainly not causal evidence, but suggests that there is a correlation between more long-term in the climate sense investors and disclosures. And that also comes out of this paper that I mentioned earlier, where we did the survey. So also there we find that more long-term investors, they do have more climate risk management tools when investing money, because they inherently care more about the long term. Despite all of that, companies remain not caring really about the long term. If you think about the actions, they respond to incentives, and they're not really penalized from not doing this. Maybe you've heard of Climate Action 100+, which is an investor initiative that engages the 176 biggest carbon emitters that are responsible for 70–80% of global carbon emissions. So these big carbon emitters, they have 70% of them net zero commitments. But if you actually look at whether they're following up what they pretend to do, there's hardly evidence that they're doing something in terms of real tangible actions. But then the last part in the last minute. So I would say greenwashing is prevalent, and Bank of New York Mellon and also Goldman were the first investors that were fined over greenwashing, pretending to incorporate ESG but not doing this. It's probably just the tip of the iceberg. The German fund BWS from one year to the other reduced in the reporting files by 75% what's ESG investing and what's not. Okay, clearly, indicating that they didn't change anything, but they realized that they have to think differently what ESG investing is. So I would claim all of that is also indicative of short-termism, exploiting the willingness of investors to pay for ESG assets, ESG funds, without actually following up on this by actually changing the world for the better. And to push this point, I have two funds here for you, and just look at that and think, what's the ESG fund? Running out of time, so I don't know. So the first one is the ESG fund. The second one is the standard fund. So the top 10 holdings hardly look different. Guess what's the main difference between the two funds? It's the fees. So the ESG fund is about 4 times as expensive as the standard fund. And that is really a problem, because I think it's going to create a lot of disappointment among a lot of people that think they invest in a green way, because they realize that they will be ripped off or are being ripped off. It goes on. So I have this paper that was mentioned earlier. We look at data from Refinitiv, a major data provider, and we downloaded twice the same data for the same companies in years, and we found that they are rewriting the data quite massively. So this is a not a random company, a company that shows strongly what they're doing. Okay, so that's for the same set of years, the ESG score of that company, and you see if if you want to know is that a clean company or not, the answer is it depends. It depends when you downloaded the data. And the big question is, of course, why are they rewriting the data? And I would say we don't have proof yet. We are speculating, and it's related, our speculation, to short-termism. That's why I have it on the slides. Because what we find is they seem to rewrite the data in such a way so that they introduce, through the rewriting of the data, a link between the scores and the returns. And so in the initial download, you don't find a link between ESG scores and returns. In the rewritten data, we find it. Now the question is, why would they do this? And the reason is, well, because investors that pay for the data, they care about the link in the data between the ratings and the returns. That's what survey evidence tells us. Right? And why may Refinitiv do that? Refinitiv may do that because if you look at the IO literature, they are a small player, and small players always want to grow and have strong incentives for risk taking because that's short term if they do that. Because in the long run, they'll have a problem if the investors figure out. Right? So we argue, as of now, we're looking at other evidence as well. So it's not conclusive yet. We argue that they may do that because they want to grow market share, so they're willing to gamble because they care about short-term increases in market share, because now is the time where the market is divided, rather than the long-term consequences of people figuring it out and so on. Okay, so what's the problem of all of that in that climate space? I think we are at the risk of seeing another major trust crisis like we have had it in the financial crisis, that because of greenwashing, because of lots of parties in the system enriching themselves by jumping on the ESG bandwagon rather than caring inherently about climate change or ESG, that lots of investors will be very disappointed. This may undermine the trust in the financial system again. And the real problem of all of that is, if we are now disappointed from ESG investing and start withdrawing our funds from the ESG funds, these funds and also the really good ones are forced to liquidate their holdings. And that has been shown to create downward spirals in the stock prices, increases the cost of capital of these companies that are doing the really green investments that we need to support. So it can actually stifle the capital reallocation that we need in order to meet and achieve these climate targets that we have now. Right? So therefore, I think in this whole ecosystem of ESG investing, we have to be really careful of short-termism problems and also point them out in order to avoid that this is going to happen. So thank you, and sorry for touching upon so many diverse issues in just 30 minutes, but we have a bit of time for questions, so I can dig deeper if you like.
Any questions? That's it.
So in the slides showing a link between features of pay arrangements and investment expenditures and R&D expenditures, so there's some evidence of short-termism, which you said was, indicated by the cutting of investment or R&D as managers were getting to a point where they could sell shares. This sort of goes to something that was said earlier, maybe by Mark or Holger or somebody else, that that sometimes when R&D or investment is cut, it's bad R&D investment that is cut. And so in these papers, is there any indication that the cuts in R&D or investment were harmful?
So this is a great question, and that's a big problem of the R&D data and CapEx data that everyone uses, which is just bunching together that all the stuff that people are doing in a quarter. So to really address it, I think one would need project level data. So the answer is no. One cannot really see whether the marginal projects were cut or the good projects or the bad projects. Now, what usually these papers do, we did it, and I think the admin's paper as well, is showing now that the second step, you report high earnings. You're more likely to meet or beat the earnings forecasts from the analysts. And also we show that in the short price, the stock price decrease, in the short run, the stock price reacts positively to the earnings surprise, but there is a reversal over the longer period. So the market does realize that if we interpret that in that way, that good investments were cut. But we don't know exactly. We just infer that from the market reaction.
I guess the market could also realize that the company is going to continue over investing in investment. I mean, maybe that's why there's a reversal.
So the reversal is especially for those firms that were cutting the investment?
Right, but let's suppose that you have a tendency to overinvest because it's aggrandizing for the manager, but you cut it in a short term to when the manager decides to sell. But then after the manager sold the shares, you go back to overinvesting. So that could also explain, that could explain a reversal in the earnings.
Right. So that's a fair point. I mean, certainly in our setting, because it's a one-time shock, we don't know. So we would have to track basically what's happening to investment afterwards. And we're basically in this study looking just at the window around the option acceleration. We cannot exclude that, that may also be a possibility. So it's definitely worth thinking about this. Yeah.
Given that climate change actually is driven by economic output, right? Shouldn't you actually encourage declining investment to improve the survival of the climate? Actually, if you all invest less, the less economic growth, and then the planet will be safe. No, why do you think investment is good?
So you mean for climate, for carbon emissions?
If you really care about the long term, you should not invest.
So that
your definition of long term, you should worry about the climate. Okay, then we should stop investing and go to the beach, and then we'll all survive. We're on the beach, and the world will be perfect.
According to that one, absolutely. So that resembles this big discussion that is currently going on about whether we should look at carbon emissions, absolute emissions, or carbon intensities. Right? Because those people that are putting forward carbon emissions as the measure, they sometimes get that feedback. We will solve all the problems. Of course, that's not the case. The question is, how do we create the same output but with less emissions, rather than avoiding growth?
Degrowth, people would say we also need less output.
We need growth. That's growth. As I see articles everywhere.
Yeah, so I would say that's not what I would conclude from this. Yeah. There's also by the way, there's also a paper that shows that in companies where you have the big four institutional investors, that their emissions are going down. So they claim it's because of engagement by the big four that they're pushing, because they are these universal holders that care about the externalities. They can't divest from the beach hotels that they have in the portfolio and so on. And according to that paper, the big four are doing active engagement to reduce emissions.
They just outsource the emissions to other companies, like you sell off dirty assets, private equity owns them, and then the public company can report their emissions.
I think that's a very serious problem. That's why there are proposals to make also ESG reporting, climate reporting compulsory for private firms. There's evidence for California that once they started to introduce carbon pricing, that there was leakage in the sense that companies were relocating outside of California. I think it's a very big concern. I've seen, some papers starting to look at that, seeing what kind of plants are being sold. And there seems to be evidence that the polluting plants are going into the dark space, where we cannot follow up on what's happening. So I think it's a very, very serious concern. Yeah. Because it's in a sense a form of greenwashing, right? So you can show, look, we reduced our carbon footprint, and not by producing less, but by putting it somewhere else in the SPVs, so to speak,
off balance sheet.
Yeah.
I have a question, Zacharias. Comment on your data, and then I wonder if you agree with it. This is about the short-termism, cutting R&D, whatever, around the vesting at the moment. And you rightly pointed out it's a local average treatment and what. Okay, but let's imagine we could figure this out. This happens at every single firm. Every firm, they all have this issue around the vesting. And there's two conclusions one could draw from this. One conclusion would be, got to get rid of equity-based compensation, because every time it vests, we get short-termism. That's bad. The other conclusion you could draw is, Well, it's an unfortunate side effect of equity-based compensation, and we can try to get rid of the side effect by, for example, having continuous vesting. There's no reason why it needs to be periodic. It could be continuous. Which one of those two would you pick?
I mean, I would definitely opt for the second. And if we have this kind of cliff vesting, or often also graded vesting with small cliffs, that we're really careful in the times where a lot of equity vests on what the company is doing. Right. So I think that's then the role of the board, supervisory board, to check this. But absolutely, am I convinced that equity-based compensation, ideally simple, are the right thing to provide effort incentives, and if we design it right, also horizon incentives.
In this regard, if I may intervene, there's also the UK Corporate Governance Code, for example, recommends that the vesting happens, although that there's a holding period requirement until after the manager has left the company. But of course, that can also create bad incentives that you may incentivize people to leave the company at some point if they actually want to sell some of their shares that they acquire.
No, absolutely. And I think what is also clear is if you put more risk on the executives by increasing the probability of a clawback or other things, that you have to pay them more on average, right? I think that's important. And you cannot say A without saying B. And often people say A, but they don't realize that B is a consequence that we need to also implement. Yeah.
But Tom, on this one, I think the biggest risk for this one is that the manager becomes very conservative. If you've got $1 billion tied up in your executive compensation, hasn't vested, and you have a chance of increasing it to 3 billion, great project, or to 0, good, on average 1.5 is great. It's 50-50, okay, but are you gonna do it if that's all of your money? Maybe not. So I think that is a real issue with these very, very long holding periods.
And I think, isn't this also what Alex Edmonds' paper on inside debt is showing, that if you have more inside debt because you have more pension tied up in the pension liabilities, debt tied up in the company, you act more conservatively. So I think that's very true.
He's in general a great proposer of this post-exit holding requirements. So maybe not sure if how he would square that with his own research.
Substantially overlap.
Any other questions? I think it's also perfect because we have to move to our next topic. So thanks again, Zach, for today.